Hey, it's Ryan from the Dividend Investors Club, and I have 3 market trends that you absolutely cannot ignore this week. If you're worried about a pullback like most people and the valuations and things of the general market, this is stuff you have to follow. This is our market trend tracker. We're staying on top of it for you, but I got 3 things I want to share with you today that I'm following closely. So this is our market trend tracker for as of January 19th. So this is things to look at for the week of January 22nd. And the first thing I want to share with you, obviously, is the upward trend of the S&P 500. We've kind of gotten a little more parabolic, if you will. If you see this chart in the upper left-hand corner here, it's an obvious uptrend. We know that, but you see this move higher has gotten a little more steep. And things we're tracking here is the spread on the 50-day moving average and the spread on the 200-day moving average. Okay, we've got a 5% spread between the current price and the 50-day moving average. That's a very large spread historically. You can kind of see how you kind of hugged this line kind of throughout 2017, and we've got almost a 12% spread now on the 200-day moving average. Okay, so just to put things in perspective, like this trend will be strong and will continue to be up as long as the 50 days above the 200 and the price is above those two averages. But we can see a pullback for sure, and in the meantime of 5 to 10%, before we really start worrying about a downtrend. So this parabolic move is something to watch. We hit 10 new highs already through January 19th in the S&P 500. The record for that is 11, which was hit back in 1964. And we have 8 trading days left in January. We're for sure probably going to hit that. This is probably going to be, again, a record for new highs in any one month, historically. So keep that in perspective. The trend is still up. I'm not saying there's a crash coming. I think from a valuation standpoint, we're not crazy stretched based on, the tax reform, earnings estimates, etc. But definitely watch the trajectory of this trend. The second thing I'm following is the second chart down here, the 10-year Treasury versus the S&P 500 dividend yield. Again, we're looking at the spread here. We've got a 0.86% spread right now. That's a very large spread. It's not a record, but you can see just since, call it like September, just how we've been widening here, right? The market's been going up, so the dividend yield has been coming down on the S&P 500. Rates are rising. They're expected to continue to rise this year. We're expecting 3 more rate hikes this year. So that spread is going to probably continue to get wider. I think you got to start watching that as the 10-year approaches 3%. Why is that significant for dividend stocks? As the 10-year Treasury, which is supposedly risk-free, gets up to a certain level, it makes high-yielding dividend stocks that may have less growth, like utilities, staples, etc., look a lot less attractive, right? So you've got a risk-free rate at 3% and a dividend, yield of, say 4 or 5%. There's no question or no, it's not a surprise why those stocks have been trading down. So that's definitely a trend to follow if you're a dividend stock investor. And the third one that you need to follow is on the sector side. So this top chart on the right-hand side here, these are all the main sectors. I've got a couple subsectors in there. But the big trend we're seeing now is cyclical versus defensive, right? You hear this all the time, but you can see it in the numbers. So all the green, obviously, this is kind of our heat map. The cyclicals continue to rally this year. You got consumer discretionary, retail, MLPs, energy, the banks and financials. Healthcare is a little bit anomaly. That's typically a defensive sector, but that one's outperforming this year so far for other reasons. But then you look on the other side of the coin, right? Tech obviously is another cyclical. Other side of the coin, real estate down, utilities down, telecom down, consumer staples 2% relatively speaking. Again, totally underperforming. So we've got that situation here where the cyclicals continue to outperform the defensive names. That, as long as that stays intact, I think we continue to move higher, right? If that's what's driving the market higher, that's great. It's banking on growth. It's banking on these earnings. These are all, if we're focusing on dividend-paying stocks, those are probably the ones that we're going to focus on. Those are a little bit, they pay less of a yield, but they also have the the growth potential to continue to rally. If we see a reverse or a rotation back into consumer staples and utilities and real estate, for example, that is when this market could end up shifting. So that's a big thing to follow. So the second page of our market trend tracker is just a chart of all those sectors, and it's all color coded. So you got green, yellow, and red. Obviously the reds are in the downtrend, yellow is kind of in the middle, and then green is uptrend. So you can see most of these sectors are in the green, and it kind of reiterates everything I was just saying, right? We've got all these cyclical sectors, not that one, not staples, that one's sideways, but all these cyclical sectors that I'm checking here obviously are in big uptrends. And then just like we talked about, what are the ones lagging? Real estate, downtrend; utilities, downtrend. MLPs is coming back a little bit. I think as long as oil continues to track higher, that one's gonna do okay and probably break out. But you can see, like I said, staples is kind of flattening out. So those are the things we're following. These charts help you follow those pretty well. But follow the general market. Follow that S&P 500 trend. That's number one. Number two, follow that spread, between the dividend yield and the 10-year Treasury yield, and then follow the sectors. If we're gonna continue to move higher, you want to be in stocks, obviously, that have pulled back a little bit if you can find those in these cyclical sectors, because those are the ones that are going to continue to move forward. But also don't ignore some of these beaten down sectors, because at some point there will be a rotation back into those. So definitely keep those on your radar as well. That's the tracker for this week. Take care, everyone. Have a great week. I think we all know that the stock market can be a scary place, especially if you're trying to go at it alone, but you don't have to do it. You don't have to be there alone. At the Dividend Investors Club, it's community investors. We're working together to grow and preserve our wealth. So if you like this video, please check us out at dividendinvestorsclub.com. Consider joining the club and joining us, and definitely subscribe to our YouTube channel by clicking the subscribe button below this video. Take care.